Hi, I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Friday, April 12th, 2024. The father of value investing, Benjamin Graham, famously said, "Price is what you pay, value is what you get." You've probably heard that aphorism. In this presentation, I'll show you how to prevent getting burned by cheap stocks that, well, deserve to be cheap. But first, let's look at recent market action. So far this year, inflation reports have generally come in hotter than expected. On Wednesday, the Consumer Price Index, the CPI for March, was released and it rattled investors. Inflation ran hot for a third consecutive month in March, raising doubts about when the Federal Reserve will cut interest rates. Odds that we'll get a cut in June have greatly diminished, souring Wall Street's mood. Overall prices increased 3.5% from a year earlier, up from 3.2% in February, driven largely by the rising cost of rent and gasoline, according to the U.S. Bureau of Labor Statistics, the BLS. On a monthly basis, the CPI rose 0.4%, similar to the previous month. Economists had expected 3.4% and 0.3%, respectively. Core CPI, which excludes volatile food and energy components and is watched more closely by the Fed, rose 0.4% in March, topping an expected 0.3%, but in line with February's rise. That kept the annual increase in core CPI at 3.8%. The BLS reported Thursday that the Producer Price Index, the PPI, which measures wholesale prices, rose less than expected in March. Wall Street heaved a sigh of relief, but make no mistake, inflation remains a persistent problem. The PPI increased 0.2% for the month, less than the consensus estimate of 0.3% and not as much as the 0.6% increase in February. However, on a 12-month basis, PPI rose 2.1%, the biggest gain since April 2023. Excluding food and energy, core PPI rose 0.2% in line with expectations. Excluding trade services from the core level, the increase was 0.2% monthly, but 2.8% from a year ago. March's PPI gain was propelled by services, which saw a 0.3% increase on the month. Conversely, goods prices decreased 0.1% compared to a 1.2% increase in February. Accordingly, the benchmark 10-year U.S. Treasury yield has been rising and currently hovers at 4.56%, an elevated level that's putting pressure on equities. This inflation and interest rate data has led to a volatile week, with stocks swooning and then bouncing back and then swooning again. During these sell-offs, should you buy on the dips? Yes, but you must be highly selective. There's a Wall Street saying, never try to catch a falling knife. A falling investment could rebound, or it could lose more value. Trying to predict the bottom is like grabbing a knife on its way down. Pain usually ensues. That said, I don't dread corrections. I welcome them. There's been a lot of froth in high-tech stocks. Pullbacks can be healthy. They present opportunities to buy inherently valuable stocks on the cheap. But you need to do your homework and pick the right stocks. Here are 10 signs to help you identify a value trap. Number 1. The stock is underperforming its entire sector. It's one thing to decline along with the broader market. It's another to perform worse than your peers. Number 2, the company shows a pattern of declining market share. Innovation never stands still. The future belongs to no single company. No competitive advantage is unassailable. Declining market share can turn into an unstoppable death spiral. Number 3, overpromising but underdelivering. Quarterly results are where the rubber hits the road. Beware of overly hyped companies with managers that talk a good game, but then miss expectations repeatedly. Number 4, insufficient cash flow to cover debt expense. The cash ratio helps discern a company's ability to pay short-term debt obligations. It is calculated by dividing current assets by current liabilities. A ratio higher than 1 shows a solid chance of paying off debt. A ratio of less than 1 indicates an unmanageable debt burden. Number 5, high levels of insider selling. If corporate insiders are dumping a stock, they know something the rest of us don't. It's a tip-off that the people running the company realize that the stock is about to underperform the market. Number 6, overdependence on a specific product or market cyclicality. Apple made a fortune from its iPod. The company recently discontinued the product because it has been superseded by the iPhone. Other companies aren't as proactive when it comes to fading products that once served as blockbusters. Number 7, high turnover in the C-suite. When key executives don't last very long and frequently jump ship, that's a sign that the company is rudderless and about to strike a reef. Case in point, in March, a series of safety scandals compelled Boeing to fire its CEO and other top executives. Once a blue-chip stalwart in retirement portfolios, Boeing stock is down more than 25% year to date. Number 8, consistently trading at low multiples versus key statistics such as earnings, cash flow, and book value. That's a sign of low future promise. Number 9, lack of institutional investment. When a stock has high institutional ownership, it's a vote of confidence from the smart money. Number 10, dividend reductions. If a company you own has slashed its payout, watch for falling or volatile profitability. Beware of an excessively high dividend yield compared to peers. If you're a value hunter, I have some good news for you. We're offering readers a free e-letter devoted to cryptocurrency. Every portfolio should have exposure to crypto, but you need to be informed to make the right choices. The experts at Investing Daily have done the homework for you. Want to tap crypto's massive money-making opportunities? Start receiving our free e-letter, Crypto Investing Daily. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching. And remember, job 1 for our investment team is to make you money.